Good morning, everyone. Once again, welcome. Our next panel, which is coming up at 10:30, will be how are private lenders benefiting from the challenging times and other dislocated private market opportunities. The moderator for that panel is Brett Hickey of Start Mountain Capital. Brett, are you there?
Yes, I am. Good morning, everybody.
Thank you for doing this, Brett.
Good morning, everybody. Hope you, your families are all doing well, and we look forward to hopefully what you'll find is an interesting panel this morning. We've got a great group of people from diverse backgrounds covering almost all aspects of private credit, ranging from a global perspectives brought from Ashley Knight, who heads up private debt coverage for Mercer, one of the largest global consultants, to a broad range of family office and institutional investors, as well as Todd Trabacco, who held the same role over at Cambridge, bringing great global perspectives and now being at more of a niche lending strategy within the railway space. And then we get into a couple different specialized aspects with Jeff covering specialty finance and Matt covering real estate, and then myself covering lower middle market non-sponsored lending, as well as lower middle market secondary fund investing. So hopefully you'll find the panel interesting, and I believe, Jeff, there'll be time for Q&A at the end, or I'm not sure how that's being managed for this. Apologies in advance, but I don't know if folks will be able to ask questions at the end.
Brett, people will be asking questions in the Q&A function box. I encourage you, to use that. And for the panelists, you can click on the Q&A and you'll be able to see the questions coming in live. So yes.
Perfect. Great, thank you all. Yeah, and so please, we do encourage, I think the more we can make this interactive and as valuable for everybody would be probably something that helps you all out. So any questions, please do type in to the Q&A chat box at the bottom, and we will get to them. We'll probably reserve most of the questions near the end, but please do type them in at any time. So with that, why don't we start with some brief introductions here, and then we'll dive into some of the topics we have, including where we all think from our different vantage points that there could be opportunities in today's market environment. So why don't we start with Ashley first. Ashley, if you don't mind giving a little background overview of yourself and Mercer, and then we'll move down the line. Thank you.
Yeah, great, Brett. Thanks again. So my name is Ashley Knight, as Brett mentioned. I'm currently heading up private debt for North America. I previously did a similar role out of Mercer's London office, mostly covering managers across Europe. And before that, did alternative asset allocation for family offices and ultra high net worth individuals at Credit Suisse in Singapore. Just a little bit about Mercer, taking a step back. Many of you may know it as an organization that focuses on consulting for health and career services, but we also have a large investment group in the wealth category as well. And within alternatives, which we think about as hedge funds, private equity, real estate, and private debt, we have about 171 billion in assets under advisement. And private debt specifically is closer to about 10 billion from an AUM perspective, mostly done through SMAs and fund of funds.
Great, thanks, Ashley. Why don't we go to Todd Trabacco next?
Hey, thanks, Brett. Todd Trabacco, I'm Director of Research and Strategy over at IT Management. Prior to that, I was at Cambridge Associates, where I was responsible for private credit manager research and selection globally. IT Management is a real assets transportation focused manager, about 1.3 billion under management. And we are known for our rail car strategy. We have 30,000 rail cars that we lease to various lessees, half of which are investment grade. And we've been around since 2015. So back to you, Brett.
Great, thanks, Todd. Why don't we go with Matt next, please? Matt, you might be on mute if you can hear us. We'll give Matt a second. I know he is on, but why don't we switch over to Jeff then, if you don't mind, Jeff.
Thank you, Brett. As Brett said, I hope everybody's family and themselves are safe right now. I'm the CEO of Sheridan Asset Management. Founded it 18 years ago. My previous professional opportunities were at Nomura, Wasserstein Perella, and developed my craft there in specialty finance and fixed income markets. Sheridan is a firm that specializes in lending to consumer, commercial, and esoteric finance companies, and also providing participating senior debt to distressed debt buyers in those same verticals. Thank you.
Great, thanks. And Matt, do you want to go next?
Yeah, can you hear me?
Perfect, loud and clear, thank you.
Wonderful, okay, great. God bless this technology. So my name is Matt Gilbert. I'm the Managing Director of Reef Investment Management. We're a division of Reef Capital Partners, a boutique real estate investment firm matching our 700 plus accredited individual and institutional investors to terrific commercial multifamily real estate investments. Some of those are on the screen right now. We offer participation in direct lending, in other words, short duration, senior secured commercial real estate bridge loans with an average 12% net return to investors and an average loan to value in the mid 50s. We have funds which take syndicated positions in those loans, offering a net 10% preferred return, cash flowing monthly, and a 1 to 3 year duration. We offer protective advances, which have an 8% return on a 3 to 18 month duration with principal and interest guaranteed by our company. And finally, we do 3 to 4 terrific private equity real estate transactions each year, targeting 20% plus annualized returns, 40 to 50% depreciation, in some cases much higher tax advantages with environmental offsets, in high growth markets with a 2 to 3 year principal commitment. We co-invest in every deal that we do with our balance sheet. We're always looking for new investors to join our family. And if you're interested, hopefully you'll find my email somewhere and shoot us an email. We can put you on our deal flow email list. And now back to you, Brett.
Great, Jeff, thank you. A little bit of background on myself. I started my career at Salomon Smith Barney, where we had a bit of a unique position technically within investment banking, with a role a little bit similar to what Ashley does now and a little bit to what Todd used to do, covering a pretty broad range of things because we owned a large insurance company, Travelers, and at the time were the largest financial institution in the US. And so we did a lot of investing on our own balance sheets, as well as buying and selling other asset managers. Given that I was at a bank and with an insurance company, a lot of the work was focused around fixed income assets. And what seemed compelling to myself and a few other colleagues was that the lower middle market seemed to be a pretty big asset class, representing about 50% of the GDP of the US economy and a big fragmented market. And so we left there to start investing in the lower middle market in 2004 when I launched my first fund. So I've spent the last 15 years doing effectively the same thing. I founded Star Mountain Capital as a brand 11 years ago. We manage about 1.2 billion of assets today. We are entirely owner operated, and we focus on two aspects of the market, which you can see at the bottom. The bottom left is our what we call value-added lending. We're really built to work with owner-operated businesses and people that want to finance some type of strategic solutions where they're looking for what we call value-added capital versus if you just want to build a piece of real estate or some, purchase some equipment, you're just looking for low-cost capital. And of course, banks are well positioned to do that for you. But if you're looking for a strategic partner to help you find an acquisition, analyze it, negotiate it, structure it, integrate it, and so forth, that's where our capital, along with our service offering, comes to play. So we call that value-added lending. The second strategy we have is secondary fund purchases, where many people on the phone here may be investors in different funds and may want early liquidity. If so, we can purchase those limited partnership interests, which we do only in the US lower middle market. That's the place where we have our competency in our network, and so we stay within that market. And that strategy has historically been a counter-cyclical strategy where in market downturns, people tend to be more interested in liquidating assets where you can often buy them at better valuations. And on the direct lending side, in market downturns, there tend to be businesses that are challenged. And for businesses that are not challenged, they can often acquire those businesses. As an example, we recently helped one of our companies acquire another business out of bankruptcy at what they and we believe was an attractive valuation. And so there's a lot of complexity associated with that. And that creates an opportunity to generate alpha or excess return in our view. So that's our business in a nutshell. And if we can flip to the next page, please, or I guess maybe we're staying on this then, and I apologize, I had a couple other slides, but maybe what we'll do now is we're going to go around and talk about where we see opportunities in the market. So as I mentioned, the two themes based on what Star Mountain does is one, helping businesses finance acquisitions. The demand drivers for that are people that are looking to sell their companies. I'm sure we're all aware that we have a retiring demographic and an aging demographic. And given that if you can successfully combine two smaller businesses into one larger business, you often increase the value of that business because the markets get more efficient as your business grows, and therefore your valuations increase. So if you can find a good strategic acquisition, that can be a very compelling way to grow your business. And so that opportunity set in the credit space, we're seeing a lot of opportunities in today, as we did in the last two downturns. This is the third recession that I'll be investing through, which we're just early days embarking upon. And then in the secondary strategy, as I mentioned, I think Warren Buffett often is pretty vocal about this, is when others are selling, that's often when he's buying. And in market downturns, I think we have not really seen right now, at least in my belief, the impact of this recession. I think people see the stock markets generally doing quite well, and it's a little bit puzzling, at least to myself and some of us, you know, how and why, other than I guess it's a little bit enlightening to see that people are optimistic. And I think it's nice from a societal perspective to see the optimism. But our view is that the second quarter that we're in right now, once those numbers become available, which will generally be the end of July and early August, sort of 30 to 45 days after the end of the second quarter, we believe there's going to be a lot of new information that is not compelling. And we query whether that is going to have an impact on the public markets. We certainly know in the private markets, it is having a major impact on a lot of businesses, and we would generally view that that will impact a lot of people that start to perhaps look to shore up additional liquidity, sell assets, rebalance portfolios, and so forth. And that means that if you have the ability to originate and find people that want to sell their limited partnership positions, and if you have the ability to analyze those assets, there could be some very compelling opportunities to buy those. And the secondary strategy, which I had a slide on, apologize that we don't have that up here for you, but the secondary strategy is the highest Sharpe ratio investment strategy. Sharpe ratio is a measure of risk-adjusted returns. So those are a couple both market commentary points and a little bit about economies, so you can think about strategies you're evaluating and perhaps think about what's going on in the economy, demographically, GDP, earnings per share, and how that might create opportunities for you, including within the two strategies we do. Why don't we now go into, we'll kind of go back and forth here. So we'll go into a niche strategy next, and then we'll take a little bit more macro perspective. So Why don't we next go to Todd? Todd, you left a large platform looking at a lot of different things to go to ITE. You must have seen opportunities there. Having known you for a long time, I know you were also concerned that a recession may be looming. Help us understand what you found attractive within your strategy, and why does this market downturn perhaps create a compelling opportunity for your strategy?
Thanks, Brett. Thank you for the kind words. Look, I think that when it comes to private credit and private debt, I think that the downturn will help a lot of people. I remember at Cambridge sensing a high level of reluctance amongst clients and prospects to entertain investments in private credit. Just a lack of understanding, a lack of familiarity. And I always welcomed the recession because I knew that the best players would survive. Even the direct lenders, even the best direct lenders who towards the end were making, and I mean sponsored direct lenders, right? Who were making highly levered loans at leverage points beyond anything we'd ever seen, and with weak documentation. I knew even the best ones would be able to survive. The marginal ones, not so much. So I welcome that downturn. And I think the opportunities now in this cycle for private credit, I think number one, starting with the most vanilla strategies, I do think direct lenders will, once they've managed to get over the problems they've encountered in their portfolio, the next vintage 2021 should be pretty good. That's what happened when I was a direct lender in 2008 and 9. Our 10 vintage was phenomenal. The distressed play is going to be great. There's a lot of distressed beta out there. Some of that's come off a bit in the public markets because of, I think, the rally in the market, in the bond market. But certainly the private side is going to see a lot of opportunity. Even some of the most distressed industries like airlines and real estate. And I think that, some niche strategies, and rail cars are a fine example of this. We're not going to see a change, right? I mean, we're already looking at our returns for this year, and we're not going to get anybody 15%, 20%, but we're also not going to get anybody 10%. We're going to keep chugging along at a 12% like we've done for the past 5 years net. And so that's a win for firms like ours. So because that shows the robustness of the strategy. So I think there are actually a lot of opportunities in private credit that LPs can avail themselves of. It just depends on how they want to do it. Do they want to reach for yield? Do they want to generate a lot of income, a lot of capital appreciation? Or are they looking tactically to invest through the cycle? I think there's a lot of stuff to choose from. Back to you, Brett.
That's great. Thanks, Todd. Ashley, you look at a lot of different strategies and you speak with a lot of different types of investors. What type of strategies do you personally think may be compelling in the current market environment we're in today as we look to forecast into the future, and perhaps why, and how are your clients thinking about opportunities they're looking for right now?
Yeah, it's definitely no easy feat that as of April of this year, there are about 450 different private debt funds in the market raising capital. I think, off the back of some of the recent market events, we're identifying particularly compelling opportunities in the opportunistic debt space. Similar to what Todd mentioned, I think a lot of these transactions tend to have a high degree of complexity that can generate attractive yields or can be asset-based. We've particularly seen some compelling offerings in the specialty finance space. So for instance, a life science fund that we're looking at now that has senior secured backing by intellectual property, and also in the portfolio financing strategies, given the potential for extremely high levels of diversification. I'm talking, one loan can have over 1,000 underlying borrowers. We've also identified some compelling opportunities in the special situation space, especially off the back of the launch of the couple of dislocation funds, as well as the activation of trigger vehicles. In addition to pull-to-par strategies in the space, we've seen some managers who have been able to structure some compelling rescue financing opportunities, given the desire for many borrowers to avoid broad syndication risk and also to achieve ease of execution. And I would say, kind of your point on the investor types, especially, you know, in Europe, a lot of insurance clients are looking for incremental yields away from their traditional fixed income portfolios. So I think senior private debt does a nice job of addressing that. But I think it ultimately always comes down to the manager you're choosing.
That's great. Thanks, Ashley. It's good to start with a strategy that makes sense, but then you need the right people to execute it. Well said. Let's get into a couple more niche strategies again now. And why don't we go to Matt first? Matt, tell us a little bit about what makes your strategy compelling in this current market.
Well, I've really enjoyed the comments from the previous two panelists, and it's a shame that we're way too small for Ashley's firm, because every comment she just made, I think, is relevant to what we do. So our business began in 2005, and we grew organically till about 2013, when we were discovered by Crestline Investors, who's a $9 billion family office out of Texas. After 8 months of due diligence, they put $100 million with us, and I think one of the reasons they like us, and since then we've aggregated a number of other institutions and accredited investors, is because we were one of the few middle market direct lenders to survive and thrive in 08 and 09. And that was for a couple of reasons. One, because of our conservative loan to value ratios, we had sort of hard caps. A lot of them in sort of 07 were starting to creep up a little bit to try to chase the deal. Todd mentioned leverage. I think that's really important. Our deals are all unlevered. Our returns are unlevered. A lot of the competition would, lower the cost of their capital and then lever it up to get the investor. We never did that. And so our investors in 08 and 09 actually ended up 6%, despite the fact that we foreclosed on about 75% of our portfolio, which brings up a point that Ashley mentioned about how complex deals equal yield, and that's true. And so our firm is staffed up to handle complex workouts. It's one of our specialties and what we do very, very well. So I think that's kind of what makes us unique. We syndicate every loan that we do across our platform of institutional and accredited investors. Our funds take a portion, typically about 15 to 20%. That helps to mitigate risk. It adds additional experienced eyes to every underwriting that we do. And then, of course, our firm also co-invests in every loan that we do, which I think makes us unique as well. We are a boutique approaching $400 million in AUM. We just got registered with the SEC. We treat our borrowers and our investors like family. None of the partners are looking to, acquire their own private jet. We're really just about finding great deals for us and our investors and co-investing together. So I feel like that's our unique story. Brett, thanks. Back to you.
That's great. Thanks. And Jeff, you've got a great edge on specialty finance. I know we do some investing in that space as well, and Ashley touched on that a little bit. Talk to us about where you're seeing some opportunities, and maybe shed a little bit of light as well for folks on any type of trends that you're also seeing.
Well, thank you. I think first of all, we have to recognize, what is going on here from unemployment, consumer spending, small business activity, non-investment grade companies, and how they're being affected by the Fed and the federal government, forbearance and local legislation or regulatory things that affect the ability for creditors to collect and execute on opportunities. I think those are really important to recognize. But what that develops in the market is a sense of uncertainty. And when you have a sense of uncertainty, if you're a well thought out investor, we've been in the specialty finance space, like I said, 18 years, 136 transactions, and $500 million of opportunity. And having built relationships with operating partners that have experience, performance, and track record, and an alignment of interest, we think there are opportunities that have shown their face today and could continue to do that, because I think the nature of when this pandemic occurred and started in the first quarter, in the types of things that we are involved in, it's a little misleading about what the environment is relative to liquidity, because first quarter in a lot of these assets which have seasonality to them, there's been the natural effect of tax return capital coming back to the consumer. And then there's the PPP program, and then there's direct payments. And so I agree with one of the other panelists that the opportunity set on the distress side and the ability to finance, especially finance companies in the natural ecosystem that might have good assets or opportunity, but just need a liquidity provider, they're going to really start to show their face in the next quarter because of some of the ramifications of data and liquidity being provided by the federal government. I think there is really a lot of opportunity to be had in the different verticals in specialty finance that we participate in.
That's great, Jeff. Thank you, and certainly always a lot of complexity when the government gets involved, right? Why don't we go over to Ashley next? And Ashley, question for you around manager diligence that I think can be helpful for everybody on the phone as they think about different managers and strategies that they're looking to invest in. What are some tips and things that you think are really important from your perspective in underwriting managers and trying to find people that can help create good long-term returns for investors?
Yeah, sure. So happy to go into that. I guess it's important to note that before assigning a letter rating to a fund, we have a robust diligence process that addresses business management, alignment, track record, and strategy. One general trend that we've been picking up on is that in the market, several managers are launching successor funds that are 2 to 3 times larger. So in order to get a better handle on whether there'll be potential style drift and that kind of thing, we spend a lot of time thinking about managers' historical investment pace as well as team adjustments to assess whether or not we believe that fund size increase is warranted. We've also noticed that several managers, offer fund level leverage, which can pose risks, especially in markets like today. So we spend a lot of time thinking about up to what level they can take at the fund, and also if they have prudent experience deploying in the past. And at the underlying loan level, we assess how net debt to EBITDA and LTV has changed, if at all, across funds. Also, from a track record perspective, we look at whether teams have in-house restructuring expertise, because a lot of managers don't have kind of cycle-tested track records, just given the emergence of the asset class following the global and systemic risks that resulted. So from that perspective, we see whether or not folks have experience doing that, as well as what historical loss rates have been, and also recovery rates as well. And then I think one important thing to note too on the strategy side is what origination channel do these managers have, because ultimately that will feed into deal funnel and percentage of deals that managers do, so how selective they can be. So a lot of different areas, and they're also in the background a lot of macro risks that we look out for, but I would say those are some tangible pieces of information that potential allocators can look to when making an investment.
That's great. Thanks, Ashley. And I guess a good reminder for everybody that we are informed by the past, but that the past doesn't guarantee the future as we look at track records relative to strategies and so forth. In a similar vein, why don't we stick with a little bit of the complexities around private credit, and from a diligence perspective, some of the other things that are probably good considerations. Todd, from your vantage point of being a credit investor for 20, 25 years now and doing research on a lot of managers, we know that covenant light deals in the last recession represented about 20% of loans, and heading into this recession represent around 80% of loans. So that hasn't really been tested. The other thing we've seen emerge a lot more increase are EBIT adjustments. Now people are talking about perhaps a COVID-related EBIT adjustment. How do you think, from your vantage point, for investors that are on the phone thinking about looking at strategies, what are a few things that you'd want to lift up the hood on a bit more when you get into the credit details to really understand perhaps risks that might be a little bit less obvious, and why are those important?
Sure. So it's a great setup too, right? Because the cat's out of the bag on direct lending, right? Everyone knows that the risks there are the weak covenants, although it's coming back a bit, I think, and EBITDA adjustments. Here's the thing: all that's in the documentation, right? And when I was at Cambridge, I used to pick half a dozen documents and I would read them. I'd sit in a conference room with my team and we would read the documents to see if what we were being told actually was reflected in the risk that was being taken. It's all in the docs. You can do that with really, and the docs are extremely important, right? If you're talking about a specialty finance manager, so someone who finances a rediscount lender that lends to the consumer space, usually that'll be in some sort of a structured vehicle with a borrowing base. Those are chock full of information, and the LPs or the GPs should give you the borrowing base. So you should be able to see what, first payment defaults were and what the covenant is there. You should be able to see what the trends are in what are known as ineligibles. It takes a little bit of education to understand the technicalities of that type of asset-oriented lending, but I think it's extremely important. So the documentation, which includes not just loan agreements, but also kind of the borrowing bases, a document suite that governs the relationship between the creditor and the borrower. And then in other strategies, I think that it might be more difficult to figure it out. So in aircraft leasing, for example, the type of airline that is the lessee, not just by the credit rating, but is it a flagship carrier of the emerging market to which you're leasing your vehicle? And I think it's really, really interesting to ask LPs or GPs what the risks are in their strategy. You should know that. So when our LPs ask us at ITE, what's the risk inherent in your strategy? We tell them two things that keep us up at night. One is leverage, and we talk about how we manage that. And the other is lease renewal rate, the maturity wall by quarter, and we talk about how we manage that. And that type of honesty and straightforwardness, I think, is pretty refreshing. I feel it is when I talk to our LPs and prospects, and I certainly felt it was refreshing when GPs would say that to me when I was on the allocator side.
That's great, and maybe for one of the things for people to look for is just transparency. I think for all of us on the phone when we're analyzing deals or analyzing managers, one good rule of thumb is: are you getting a lot of transparent, clean, organized information? And that's a little bit of I kind of think of that as a sniff test. And I know, having gone through, I can certainly attest to Ashley running a very thorough diligence process, having our team gone through that. And I think that that's really important as private credit. Ashley, you mentioned there are currently almost 500 credit managers right now in market. Is that right?
Yes.
So if you think about how many different managers, 500 private credit managers, how do you possibly sort through those to find the best ones unless you really have a robust team and a framework to peel through and analyze all of those. And as Todd starts to talk about some of the complexities, the other thing that has emerged is people can say, this is a first lien loan. Well, does that first lien loan detach at a 6 times leverage attachment point or a 3 times? That's a very big difference in risk profile for something that historically, if you said first lien loan, people would generally think, okay, I can appreciate what risk bucket that probably falls in. I would argue today that you really don't know until you actually get into the granularity and the details, which Todd was talking about as well, which really means getting into documentation, loan and security agreements, and specific information. As we had a question come up, and encourage people to put questions in. This one's directed over at Matt from a real estate perspective. Matt, when you rub your crystal ball and look at real estate valuations, how do you think real estate will be impacted, generally speaking, across the US? You may want to bifurcate it between commercial and residential, if you will, but more of a macro US real estate question versus specific to your strategy.
Thank you for that question. I think that's going to depend on how quickly we recover. I mean, we're seeing Obviously, there's a lot of impairment going on in the hospitality space. I was on a call the other day with, I think, 300 asset managers and talking about the forecast for commercial space. And I think 75% of these wealth management groups, including some very, very big names, said that they saw in the medium to long term, they would be reducing considerably their office space, their commercial office space, in favor of telecommuting. So I think that's something you have to look at. We don't do residential, so we see pretty steady growth in the multifamily. So I think that really just depends on where the economy shakes out after COVID. But in the commercial side, we're definitely seeing impairment on the hospitality side, and I think there's some softness to the commercial office space as well. Thank you.
Thanks, Matt. We had another question come in. I won't say everybody's full names, but first name, Gustavo, asking about due diligence in today's COVID environment. A great question, Gustavo. Thank you for that. And his question is, how has really, I'm going to paraphrase this a little bit, but how has underwriting changed? How are we all doing due diligence in this type of environment? When you think about a lot of the things that are often done in person, whether it's plant visits, getting to know the management teams and the people that you're underwriting, how are you dealing with that? And why don't we'll go around the table quickly with this question. Everybody can have a quick response to this. One of the things, Gustavo, we're doing is first we're using video conferencing a lot more to get to know people better, and then doing as much of the due diligence as we can with the view that we likely won't be closing on a number of different transactions until more of the July type of time frame, until there's a little bit more clarity and transparency, and depending on what the business is and its end industry and whether it was impacted and whether one needs to be considering economic recovery or not. For example, we invested recently in a telehealth business, or did an add-on investment with a telehealth portfolio company of ours. We already knew the management and the growth is quite clear for the business, so we didn't have any COVID related concerns. But there are other businesses, if you think about things like private preschool chains and a whole bunch of things, that it depends on the state you're in and a lot of complexities. And at least the view that Star Mountain Capital is taking on that is we're trying to keep those opportunities alive, but slow rolling them a little bit. Why don't we go around, and let's go to Jeff next. Jeff, how are you dealing with due diligence and any changes in diligence, perhaps tips for people in today's market environment?
Well, having done this for 18 years and lived with these transactions from cradle to grave, the due diligence process that you create is one that has changed over time because of technology. And so when you're financing a company and you need the data and the information to be able to make decisions, a lot of that information can be deployed in a Dropbox. And so what we're doing is, as you have said, we're looking at opportunities now and preparing for June and July to be able to execute and provide liquidity to these transactions. But you can do all the things that you want to do except your site visit and meeting the principals, which is something we do on every transaction. So our due diligence process has maintained discipline during this period of time. We just aren't going to close on any transactions until we can make physical visits to the counterparties that we're participating with. So I believe, this is a time of preparation, of doing your diligence on transactions that you normally would do, which really has been provided through Dropbox and technology. Complete those types of things, and subject to your site visit with the principals, you then can conclude a transaction and execute.
That's great. Thanks, Jeff. Todd, how are you guys doing your underwriting today? Anything different?
Yeah, so it's pretty easy for us. To be honest, in this environment, there isn't much of a change. Look, we buy rail cars. We've got a pipeline of 800 million rail cars we're going to be looking at over the next 9 months or 6 months, and you don't have to go and inspect them, right? They have a year, they have a registration, right? I mean, you know the type of car, you know how old it is, you know the manufacturer, and so you more or less know.
And cars, I think, are immune to COVID, as far as we know.
Cars are immune to COVID, but this is also interesting, Brett, because for grounded aircraft, right? We also have an aircraft strategy, so I know enough to be dangerous. For grounded aircraft, if you're buying a grounded aircraft, you really have to inspect it, right? There are regulations with respect to the local aviation authorities that you have to comply with. So something that's sitting on the ground today in China, Indonesia, Croatia, you buy that airplane, even if it's on lease, you got to inspect it. You got to make sure it's okay. You don't really have that issue with a rail car, right? And like with shipping, right? Any ship that's in dock right now, you got to make sure that the crew hasn't buggered off somewhere to become truck drivers or whatever. So we have a pretty easy time of it, to be honest. I'm afraid I don't have much to add to the conversation because the assets we buy are very fungible. You know what they are. They don't require a lot of startup costs or startup reviews. So we're actually we're not really changing how we do diligence in this environment because we just simply don't need to.
That's great. Nice to hear. Matt, how are you guys looking differently, if at all, in your underwriting process right now?
Yeah, so I would echo sort of all the above. We're using technology to the extent that we can. We do a site visit on every property we lend against, or we're doing a number of developments. We're always on site. We're conforming to state, county, and federal rules regarding distancing and whatnot. My idea for a branded hazmat suit was shot down in committee, so we're not wearing those. But one thing that we're doing is we are discounting appraisals. So as appraisals are coming in, we're adding kind of a 20% COVID discount in our underwriting. I would say that's just kind of one of the things that we're doing that's different. But other than that, I echo sort of everything that people have said here.
Great. And Ashley, when you're diligencing managers, go ahead. Sorry.
No, I just wanted to add on, when we're talking about process and what you do differently, I think your process has to be consistent. I just think the assumptions that you put in those processes have to change based on current and future projections of where you think your collateral or your cash flows are going to perform like. So, yeah. But I think it's important to have a consistent process.
Well said. Ashley, when you're diligencing managers, I know having gone through, you're very data driven in information, which is great, so that you can do in a socially distanced manner. What about other parts of your manager due diligence? How is that impacting your current manager research?
Yeah, sure. So as you mentioned, I guess it's important to note that despite the pandemic, our diligence process has remained the same so that we can be congruent in terms of how we assess managers and being fair from that perspective. With that said, obviously on-site diligence looks different in the post-COVID world. There have been a lot of WebEx and Zoom sessions. With that said, we found that aside from the dislocation funds I briefly touched on earlier, many direct lending managers have been pushing out their fundraising timelines. So whereas if they would have launched normally in Q2, they're saying they probably will come back closer to Q4, Q1. Part of that's because they're working through existing portfolios, and part of that is because, if possible, they'd prefer to have all of the on-sites done in person. And I think in terms of our process and questions we ask, we've also made some amendments to that, anecdotally, maybe thinking about how, if at all, natural catastrophe risk is embedded into investment committee memos, as COVID-19 is more cat risk than 08 related. And I would say in terms of observing managers, what are they doing today to monitor their existing positions? Have they been proactive in offering covenant deferrals, or are they influencing their GPs to inject additional capital, or supporting borrowers to gain access to government financing? So really, observing how these managers are handling the current crisis to get more comfort around, future allocations.
That's great. Thanks, Ashley. And I know Todd, separately from your diligence perspective, having gone through also some of your personal due diligence as an investor with us, you like to really get into the details and understand everything. And so this is probably a good market environment that I assume we would all agree that, you don't want to be catching a falling knife, shall we say, so making sure that people are really understanding what they're getting into, what the impacts could be. And that then dovetails into, I'm going to try to combine a question from both Vera and Ed as far as some questions here, which is really around the fact that the market downturn could be a depression, in addition, something deeper than a recession, in other words. And how are people thinking about that? And then Ed's question kind of dovetailed is, where do you see opportunities related to that? And have those opportunities been created by the pandemic? So and maybe we'll go around quickly with that kind of combined question a little bit as well. So what I would say on Star Mountain's two strategies, the direct lending side, where mostly we're really doing acquisition financing. The difference today is that we, for example, just helped one of our portfolio companies acquire another one out of bankruptcy. So time will tell if it happens to be extremely accretive, as we think it should be. But you need to understand how to do that. You need to understand the complexities of doing that. So that is, bankruptcies happen in all markets, but the pandemic certainly is increasing dramatically the number of challenged businesses out there. So for people that have the expertise in that, Ashley talked about dislocated, distressed type of investing, that type of thing. If you have the capabilities to do that, that is certainly heightened materially from the pandemic, and it's really hitting sectors that a more normal recession, would have not hit. So I think that certainly creates other opportunities, and for Vera's point, challenges as far as how are you dealing with failed transactions. I guess from our perspective, we're always very clear in our documentation that we can pull out of a deal at any time for any reason. You may have read in the paper different private equity folks and stuff that once they're kind of locked into things, I think that's a different dynamic and a different risk perhaps than you generally see, always exceptions, but generally than what you see in the credit space. And why don't we flip over to Matt this time for this question, as far as, and maybe even to refine the question a bit, what do you think the recovery is going to look like, and how does that, create again some opportunities for you perhaps?
Well, boy, I wish I had a crystal ball. I mean, I think, from our perspective, we've got those, our average loan to value is in the low to mid 50s. It's getting lower. The deals that we're seeing in this environment involve, better borrowers, better situations. A lot of the middle market lenders are, currently focused on babysitting their existing portfolio. They are a bit cheaper than us, and so we're seeing, better opportunities, and that's going to probably bring our portfolio LTV average further down, which is good. So again, we've always been opportunistic. Like I said, we did fine in 08 and 09, and so we're anticipating. We actually just finished a common stock raise. We're in the middle of a preferred unit raise to build our own balance sheet, so that we can, as a company, take advantage of some of the opportunities in the market out there. I think that the recovery, we're just going to have to see how this all plays out. I couldn't make a call on what the future looks like, but as long as our LTVs are low and our firm, we've got the experience, 15 years in handling complex workouts. We feel I don't want to say excited, but we're certainly taking advantage of the current situation.
That's great. Jeff, anything further to add from your standpoint as you look at data at the consumer level in particular? Any sort of views as to what type of recovery this might look like, and perhaps does that further heighten any opportunities? And I know you've generally already addressed that, so maybe just more of any data you see as far as trends that you think are helpful to share with folks.
Well, I think when we approach this, and after seeing what's happened, most of these assets, whether they're small business loans, consumer loans, equipment, any of these credit-related opportunities, resi mortgage, there's a seasonality factor in them. And as I mentioned before, the fact that these things have happened in the first quarter, and you've gotten great federal support to the consumer, and you've gotten the normal liquidity that occurs in the first quarter, we think, we're not trying to be in the business of being economists. We have to assume the worst, and we assume an L recovery, and we assume when the data comes out going forward that we're going to start to see that there are more issues and more liquidity issues that are facing us. Having said that, when you evaluate these opportunities, there's a couple of ways to go. There's investing in transactions that are less correlated, like litigation finance, where they're not based on economic circumstances, and your obligors are investment grade insurance companies. That's one way to approach it. Another way to approach it is if you're financing charged off consumer debt. Well, when the diligence is done with the partners that we finance, there's tremendous idiosyncratic detail underwriting that's done. But one of the key drivers is when you get a portfolio and you diligence it, you get to see how many people are employed in that portfolio. And so from there, the portfolio that you're financing is one that your assumptions are, at this point going forward, these people are showing that they're employed. And from there, you assume very benign recovery, and you make sure your principal return is short duration, and you make sure you're in transactions where your attachment point allows you to be 50 to 60% of what you expect the recoveries to be. And if you take those sort of basic tenets along with others, I think you can mitigate by attachment point and assumptions being a true liquidity provider. Because we've been in business 18 years, we've built a brand focused on small to mid-sized sellers and finance companies. We believe that our funnel will allow us to get situations where the attachment point will marry a very benign recovery going forward.
That's great. Thank you for sharing, Jeff. And it sounds like most of us do believe that the fundamentals of companies are going to get worse still before they get better, which the stock market probably doesn't show you a similar assumptive pattern, one might suggest. Ashley, from your guys' perspective and vantage point, how are you thinking about, let's talk about the U.S. economy, because I know your firm is global, but when you think about the U.S. economy, what shape or combination of shapes do you currently forecast recovery looking like?
Yeah, so we don't kind of predict, because I feel like this is a first time scenario for many. You can't use 08 as a proxy or whatever else. So I think we more so think about it as in terms of timing and where we think opportunities are in the short, medium, and long term. So in the near term, we think that there's a very attractive opportunities for managers that are able to provide liquidity where there are forced sellers or otherwise high quality assets. We think these opportunities tend to exist where either buyers exit the market for a time or holders are under pressure to generate liquidity, both of which kind of creates a market imbalance. And then I think the opportunity is typically for short-term gains of around 10 to 30%. And because of the duration of the opportunity is short, the multiples that we're able to predict kind of tend to be higher with modest IRRs. So I think from the short-term perspective, it's really about bridging that liquidity gap. And I think more medium term, I talked a little bit about some of the dislocation funds, which have been able to raise capital on a contingency basis, and kind of are able to look at the opportunity set and kind of act based on where they see opportunities, whether it's pull to par or rescue financing situations. And then I would say kind of more long-term is on the distressed debt side, the ability to acquire loans at depressed levels and work with borrowers on a restructuring that would allow repayment of the loans. But as I mentioned, this process takes time. So historically, we've observed that, multiples earned have tended to be fairly consistent. But, over time, the IRR would be degraded. So that's kind of how we think about it in chunks in terms of kind of predictions and the current opportunity set.
That's great, Ashley. And as you think about the secondary space, which over the last 20 years has grown materially, and you overlay that with the private credit space, which, as you've mentioned, there's nearly 500 current managers in market now, and there's been a substantial increase in the number of private credit managers in the past decade in particular. How do you think about secondary credit type of opportunities? Is that something your firm has looked at? I guess where you mentioned you may have a motivated seller and perhaps some complex assets, which is hard for a motivator seller to understand. If you can have buyers to look at that, is that something you've looked at within the credit space?
Yeah, so we've been approached a bit over the years on the secondary side. I think relative to what we've seen in private equity and infrastructure secondary deals, it's quite nascent in private debt, just given when a lot of these strategies have launched, as well as the shorter durations. But right now, I think a lot of the secondary activity, at least from what we've seen, has been kind of put on a standstill until people get a better understanding of what their portfolios look like once valuations are available and everything else. But I do believe that once things level off, the secondary private debt opportunity set can be quite attractive, especially if it's with managers that you know well and are able to get the visibility and transparency you need at the underlying loan level. I think in addition to kind of the mitigated J-curve that you'd be able to achieve, there is just so much inventory, and they're going to be asset owners that are kind of forced to sell out of certain positions, not so much because the funds aren't doing well, but more so just because of change in plan in terms of asset allocation off the back of the pandemic. So I do think that there should be some interesting opportunities in the space.
Great. Well, I certainly hope so, because some of my chips are going in that direction. We had another question for you, Ashley, as well, relating to ESG. We know ESG is something that has been growing in popularity and in interest, but is sometimes challenging to analyze in general. I guess maybe just a high level question, try to take a question that Christian asked and bring it into something that is as broad as we can have. How is your firm currently thinking about ESG, which I think is a really nice proxy for how a lot of investors broadly are thinking about ESG? Anything that you think would be helpful for either A, when people are looking at due diligence, how they may consider ESG, or B, for managers that may be on the phone with us, things that they should be thinking of?
Yeah, sure. So since 2008, Mercer has assigned an ESG score to each private market fund that we've assessed. And when you think about private debt relative to what you would see in private equity or infrastructure, ESG is a bit trickier just because of the lack of control that lenders have. But with that said, we are able to think about ESG and assign a score when thinking about certain components of managers' processes. So for instance, does the team get regular training and testing on ESG factors at the loan level? Is there an ESG section in their IC memo? And how do they think about that? Is there an ESG head at the firm, and do they have a decisive vote at the IC level? How, if at all, ESG is monitored over time? Are there KPIs created at the underlying loan level that are then tracked and reported to investors on a regular basis? And then I would say kind of beyond ESG, but on the same topic, we have seen the emergence of some managers not only thinking about ESG, but also making sustainable investments. So for instance, one manager that we invested in the Nordics made a loan to a mushroom company, which is one of the most sustainable types of source of kind of energy and food that you can get. And they were able to combine kind of that loan with a broader sustainability goal and Some managers have actually launched sustainable private debt funds, not as many as you would see in other asset classes in the private market space, but something that I think will grow exponentially in the next 5 to 10 years. So I think that's one way of not only getting paid back, but also aligning yourself with the borrower. Because if you are lending to a sustainable company, if they do well by nature, you do well, but also the world is better. So depending on which elements you care about and what relates to your strategy, that's one thing that I think is going to increase in popularity over time.
That's great. Thank you, Ashley. And we certainly hope so. And also, I think there's continues to be data, and as the world becomes more transparent, all stakeholders, from employees to customers to vendors to investors, at least care a little bit. And I think that care is growing. And with transparency, people care about that. So if you want to attract and retain and motivate top quality talent in today's environment, I know I sit on the global board of Harvard's Alumni Entrepreneurs Association, and 15 years ago, it was all about let's make money, as AIA mentioned at the beginning of this. They started being a hedge fund space, and there was a ton of interest in let's make as much money as we can and really focus on that. As the hedge fund space has reduced and people are more interested in what am I doing, what value am I creating, that is, I think, correlated ultimately with ESG as well. Let's go around now for a quick fireside. If there are any last questions, please feel free to type it in, but perhaps closing type of notes. Why don't we go across, and let's start with you, Matt. We'll go in order of Matt, Todd, Jeff, and then Ashley for what's shown on the screen. Matt, what's a parting thought that you'd like to share with people, please?
Oh, parting thought. Let's see.
Can't make this too easy for you.
Yeah, let me jump in the lotus position. Give me a second. All right. I was on a call 3 weeks ago with a $4 billion wealth management firm we've been speaking to for the last couple of months, and they've just begun ODD. And his response to me was, "You're lucky to be in private assets." And as an investor as well as an employee, I feel the same way. I think if people are looking at the public markets and they're like, yeah, this is a great time to buy, and they're going to jump in. But it's like when you look at the S&P going back the last, 30 years or so, I think the returns are somewhere like 4%, net of fees, or maybe 4.5%, not even adjusted for inflation. So, the great thing about alternatives and kind of what we all do for investors is, accredited investors, you don't have to be Warren Buffett in order to see a low double digit, even a mid double digit return in something that's got a risk profile similar to, an A-grade corporate bond. That's my parting thought, Brett. Thank you.
That's great. Why don't we go to Todd next? I know Todd's got a bit of a hard stop, and then we'll be ending this panel about 5 minutes. Todd, what's an interesting parting thought?
Well, it's the parting thought I give. It's the opening thought I give on a lot of panels. If you're thinking about alternatives in privates, what can private equity do now? If you're allocating to private equity, what are your choices as an LP? Sit this one out and wait for the next vintage. That's pretty much it, right? But if you're allocating to private credit, you got a lot of options. You can capture the cheap beta on the distressed play and generate some really good returns for the next couple of years, and that'll come off and you can reallocate elsewhere in 3 years. You can allocate to uncorrelated strategies. Jeff mentioned a couple: litigation finance, music royalties, rail cars are uncorrelated. Or you can play the distressed a different way. And I think that's really the wonderful attribute of private credit, is that LPs can really pick what risks they want to assume, and they can allocate through the cycle and in response to the cycle. And I think that is a real differentiator against other private strategies. Thank you, Brett. You did a great time as a moderator.
Thanks, Todd. Jeff, parting thoughts of wisdom, please.
My parting thoughts for the investor community is, if you make a decision to participate in the private debt space, that's sort of your macro decision. But what's critical is, one, being with a operating partner or manager that doesn't have to put assets out. They're not forced to put assets out. They put good assets out. Two, you want partners that have gone through multiple cycles so that they understand and can differentiate the different things that occur based on those different cycles. Three, you want to make sure operators have institutional quality vendor relationships with their lawyers, their forensic partners, their auditors. You want to make sure that they've worked together during periods of time of distress, along with number four, the management team. Has the management team worked together through downturns? Five, has the management team managed these assets from cradle to grave to understand the echo path of all these transactions? And five, make sure, and six, make sure you're with partners that are transparent and willing to get on the phone and give you good and bad information. Those are the things that are critical in private debt, that you must get transparency and you must have a relationship with the manager who's willing to give you the good information and the bad news.
Well said, Jeff. Transparency is really a critical pillar of any type of partnership and relationship, isn't it? Ashley, parting words of wisdom, please. Or provoking thoughts,
yeah,
whichever,
sure.
whichever you like.
Yeah, no, I think it's really about understanding the managers that you're allocating to, their restructuring expertise, incumbency, deal structuring, track record, institutionalization. It's all so important. And then I would say just ensuring that you're building a diversified program, because much of private debt is ultimately downside protection.
Well said. And I think to Ashley's point on downside protection and to some of the other points that have been made, what I would summarize is I think private credit can have the opportunity for a very attractive risk-adjusted return as well as absolute returns. If people want some additional information on ways that can be measured, I'm happy to share that. Alpha is one way that you can look at relative value or excess return over risk. Another is the Sharpe ratio. There's a lot of different mechanics out there for it, but those are certainly two major ones, and we've certainly observed and experienced that you can create quite attractive returns from different private credit spaces. So thank you, everybody. We hope for all the participants on the phone that this was helpful and constructive for you all. We appreciate your time. And thank you to all our panelists, Ashley, Todd, Jeff, and Matt. Appreciate that. And to our great organizing group, of course. So thank you, everybody. We wish you all well and look forward to keeping in touch with many.
Thanks, everybody.
Thank you, Brett. Appreciate it. Excellent.